Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so US stocks finishing up on the day, but off their highs. Tech managing to outperform. Tesla was pretty buoyant. They've got an investor day coming. I think that's today actually. And then Europe and China also had a good bounce after last week's weakness, where they were down 5% in China, 2% in Europe. So a pretty strong recovery from those indices. VIX also headed lower. As for now, the kind of technical breakdown below that 200-day moving average hasn't really happened on S&P. It threatened, but it's been averted. Commodities were mixed, with natural gas continuing that violent bounce. It was up 10% last week, added another 5% to that yesterday. And then copper actually retesting that $4 level again to the up, this time coming as a resistance level, because we obviously shot through that slightly. And now we're going to test to see if that holds as a resistance. And if it does, then you'd be thinking the technical setup is for a move down, probably towards that 360 area before you get any major support again. Now, vols were whacked. You see about one vol in NASDAQ and S&P. So they just kind of, we do think European indices also got whacked. 1.5 vols there in Euro stocks. We think that could continue into Friday because there seems to be a bit of a lack of major data until then. We've got ISM services on Friday out the US. In commodities, the major mover in vol terms, 8 vol drop in natural gas down to 77. That's quite reasonable size drop given how much it's moving. It's moving on 94 and it's in negative carry. So interesting to see that vol offered so heavily. And then oil and copper vols firming up as well. Not massively, but just versus the other vols that are a bit softer. Positive carry does remain across most stocks. Less so in Euro stocks at the minute and US indices. The most carry you're getting is really in the likes of FTSE and even China right now. So that's kind of working for the theta earners. And then in precious metals, we've got positive carry still here, as that stuff just doesn't really realize right now compared to its vol levels. Whereas copper seems to be the best mover in commodities right now in terms of if you were long gamma. Skew having a reasonable move back down, half a vol in US, but more so in Europe. European skew did some kind of explode somewhat last week. So giving that back, we mentioned in our weekly report that we did think realized skew in Europe was kind of very low, and we didn't think these skew levels were very sustainable unless we got a material move lower and a real pickup in volatility. And clearly, yesterday's 2% rally was the market's answer to that, and we saw skew get crushed very, very quick. And then looking on the other side, on commodities, oil and nat gas skew also caught a bid here. Other skews a little bit softer, and we saw copper skew flipping back into calls, but that's been kind of oscillating around that 0 level for some time now. So no sort of clear theme there in copper. Okay, moving on. What charts are we looking at? So here, mixed signals. So what we've said is, obviously, we've got month end today, so don't want to read too much into the market price action. We think it's going to be fairly noisy with month end. We mentioned the other day that there may be some sort of positive charm flows into options that are expiring on month end, which may hold the market up. And then we might see a real move later on in the week, particularly with ISM if that comes out not too friendly. Now, we have got the big data point out next week is going to be the non-farm payrolls, right? That's the thing that started all of this madness in yields. And so we're going to see if the data the following month comes out as strong, or was that an anomaly, and how's the market going to react? So whilst ISM services is likely to create some vol, the real vol should be expected on non-farms, which is next Friday. And then in terms of markets chopping around, 0 DTE options are still driving quite a lot of vol. We did see our friends at Spot Gamma put out an intraday tweet yesterday when some 0 DTE put flow came in. It was a great signal. So their hero indicator worked to treat there. I actually traded off it myself when they said they were seeing a load of 0 DTE puts, and we saw those flows turn, just slotting out some S&P up at 40.15, which was their resistance level as well, worked out as a really nice trade, and we saw a quick 30 points lower. So those sort of flows and the systematic de-risking that seems to be going on. Charlie McGilligan of Nomura has been putting out that they probably about 45 to 50 billion of outflows out of these systematics in the last 2 weeks. So that has clearly had an outsized impact on the market. But if we close below those 200-day moving averages, below that 39.40 area on S&P, then there may be another 50 billion or so to come out of those type of investors, which was going to clearly keep pressure on the market. And that's what might trigger that move down towards that 3,800 area that we think may be kind of the bottom of the range in that big 400-point range that we're trading in on the S&P. Now, looking at these charts, we've got these economic surprises obviously have turned higher since that non-farm print surprised everyone to the upside. So we've seen the SESI index trade up, but the S&P hasn't really followed it. So you see over time, these things can kind of trade in tandem with each other, but they do diverge. And we saw a divergence kind of back in September, October last year. We're seeing a divergence again. The way that divergence was closed was with the economic data rolling back over into kind of December, January. It wouldn't surprise me actually if the same thing happened again, where this economic data does roll over into the summer and catches up with the S&P. But we are seeing that divergence there right now. And then if we look across the NASDAQ versus 10-year yields, again, similar story, kind of tracking each other. This time round, we've got NASDAQ up at 12,000, whereas versus 10-year yields at 4%, you'd expect this thing to be a good 1,000 points lower, which it isn't. And I would put that down to the likes of, these big tech names were massively shorted at the start of the year. It was quite a hated sector, and that short covering rally has kind of created this divergence, basically, right? So I think it was a positioning thing, and that's what's created that divergence. But the point being that a lot of these relationships that were kind of in place last year seem to be breaking down right now. And so what we think is just waiting for more data is the right strategy, right? You don't want to make any big calls right now because there's too many mixed signals in the market. Okay, now something we've noticed and we've been talking about recently is commodities, relative value. Generally commodities are screening as a good time to kind of get into calls. If you're still a bull overall on commodities, a lot of these commodities are parked in the buy calls area. We've been particularly looking at gold because we want to get into some gold calls down near this 1800 area. We think it makes sense. We think gold's got a lot going for it this year. We think the dollar's likely topped, and that's going to be good for gold. Now, how would you get into that trade? There's various expressions. We did mention in our 42 macro overlay that you could buy gold call spreads out to June as a nice 3-to-1 risk reward play. Nice and simple. Obviously, in this show, we like to be a little bit more sophisticated by the way we use options for the more advanced users. So another implementation of the gold bullish trade may be to actually buy very low delta, like 10 delta calls on gold, funded by silver puts. Because if you look at silver and gold, you look at the relative performances, silver's underperformed quite badly. And that's it for today. So that's a way you can use relative value vol in getting yourself into commodities at what looks like a decent entry level. Cheers.